Tonight we're diving into a staggering number: $100 billion, the largest single auction of 4-week Treasury bills in U.S. history. This record-breaking event, happening in August 2025, signals just how urgently the U.S. government needs cash. The government is issuing this new debt to pay off old debt that's coming due. Think of it as using one credit card to pay off another. Nearly $195 billion in similar short-term securities are maturing this month, forcing the Treasury to keep rolling over debt. This cycle shows how dependent the country has become on a constant flow of borrowed money to cover daily expenses. The Treasury is leaning heavily on short-term borrowing, which offers flexibility, but also creates relentless pressure to keep borrowing. Relying on these short-term loans means the government is highly sensitive to shifts in investor confidence or interest rates. The core issue: the U.S. is spending far more than it takes in. This record auction is a symptom of that larger problem, a temporary fix that keeps the government running but doesn't solve the underlying budget gap. Each new auction patches a hole in the budget, but the road ahead is getting shorter and riskier. It's a high-stakes balancing act, and the world is watching to see if the U.S. can maintain its footing. The sheer scale of this borrowing is a warning sign. The government is walking a tightrope, and any misstep could have global consequences. The question now: how long can this cycle continue before something gives? How does the government borrow all this money? Through a high-stakes process called a Treasury auction. The Treasury offers $100 billion in 4-week T-bills, and investors, from big banks to individuals, bid for a piece. They specify the lowest interest rate they'll accept, making it a competitive process to keep borrowing costs down. There are two types of bids. Media. Banker presenting two options on clipboard, close-up of financial forms labeled bid type. Competitive, where big players name their yield, and non-competitive, where smaller investors accept the final rate. The Treasury fills non-competitive bids first, then moves up the competitive bids until the full amount is sold. The highest accepted yield sets the rate for all winners. If investors get nervous about the economy or government finances, they demand higher yields, making borrowing more expensive. For this auction, T-bills were issued August 12th and mature just 4 weeks later. When they mature, the government pays back the principal plus interest, often by holding another auction to borrow more. This cycle of borrowing to pay off old debt keeps the government running, but the numbers are now so large that the system is under strain. Every uptick in yield costs taxpayers billions more over time. The process works, but the stakes have never been higher. The question is, how much longer can this cycle sustain itself? The announcement of this record auction sent shockwaves through financial markets, flooding the market with new debt shifts, supply and demand, pushing yields on longer-term Treasury bonds higher. Higher yields mean it's more expensive for the government to borrow. And for you too, since many loan rates are tied to these yields. Recent bond sales show yields climbing: 30-year bonds at 4.81%, 10-year notes at 4.26%, much higher than before. This isn't just financial news, it affects mortgages, car loans, and business borrowing. The market is bracing for even more government debt, driving yields up further. When bond prices fall, yields rise, a classic economic principle. Investors are watching closely, as these moves signal the health of the economy and future Federal Reserve decisions. The once stable bond market is now volatile, making financial planning harder for everyone. The tremors from this $100 billion auction are being felt across the entire financial system. In this era of uncertainty and rising rates, investors are changing tactics to protect their money. Hedging, like buying insurance for your portfolio, is now common, with pros using T-bill futures to guard against losses. Futures contracts let investors lock in prices today for T-bills delivered later, offsetting potential losses if rates rise. Some are exploiting tiny price gaps between physical T-bills and futures contracts, a strategy called basis trading. Investors are also adjusting the mix of short and long-term bonds to balance risk and return. Despite the risks, demand for short-term T-bills remains strong. They're seen as safe, quick, and low risk. This demand helps the government borrow at lower costs, but it also reflects market anxiety. Investors are prioritizing safety over higher returns. Success now requires agility and advanced strategies, not just buy and hold. The old rules are out. Today's market demands constant adaptation. Navigating this landscape means using every tool available to manage risk. In a volatile world, safety and flexibility are king. Why the shift to short-term debt? With high interest rates, the government doesn't want to lock in expensive long-term borrowing. Issuing short-term T-bills lets the Treasury fund operations now, hoping rates will drop in the future for cheaper refinancing. This strategy offers flexibility and taps into strong demand for safe, liquid investments. But it creates a new problem: the need to constantly refinance, exposing the government to interest rate swings. If rates spike or investor appetite fades, borrowing costs could soar, straining the budget even more. At its core, this is a temporary fix for a deeper issue: the gap between what the government spends and what it collects. Issuing mountains of T-bills delays tough choices about spending or taxes. It's a high-wire act that depends on stable markets and investor confidence. The risk this patchwork approach can't last forever. While T-bill demand is strong now, experts warn this path isn't sustainable. The root problem is the ever-growing national deficit, spending outpacing revenue. Relying on short-term debt could get harder and more expensive if investors lose confidence. External shocks like new trade tariffs or stagflation could make things worse. Lower tax revenue, higher spending, and even more borrowing at higher rates. The Treasury's current strategy solves today's problems but may plant seeds for a bigger crisis. If fiscal imbalances aren't fixed, the U.S. could struggle to finance its operations, triggering higher borrowing costs for everyone. This isn't a distant threat, it's a challenge that needs urgent attention. The record T-bill auction is a warning sign. The clock is ticking. Ignoring long-term risks for short-term fixes is a gamble the country can't afford. The U.S. Treasury market is deeply connected to global finance and domestic regulation. A proposed law, the Genius Act, could require stablecoin issuers to back their currencies with treasuries, creating new demand and new risks. The Treasury set aside part of this auction for foreign central banks, highlighting the importance of global investors like Japan and China. Any shift in their strategies could have immediate consequences for U.S. borrowing costs. Events in other economies like major bond sales in Europe also affect global capital flows and U.S. debt management. The actions of central banks worldwide influence investor sentiment and the Treasury's ability to manage debt. U.S. policymakers must juggle domestic needs, global events, and regulatory changes. The stability of the debt market depends on this delicate balance. The $100 billion auction is a reminder: no economy is an island. In today's world, every financial move has global ripple effects. This record T-bill auction isn't just Wall Street news, it affects everyone. The government's reliance on short-term borrowing means more volatile interest rates for mortgages, car loans, and credit cards. The era of stable, low rates may be over. Borrowing costs are now more sensitive to government debt needs. For investors, old strategies may not work. Agility and diversification are key. Understanding terms like yield, deficit, and T-bill is now essential for everyone, not just economists. Massive government borrowing impacts your savings and loan costs directly. Staying informed and adjusting your financial plan is more important than ever. Financial literacy is a must in this new era. We're all stakeholders in the nation's financial health. The government's debt decisions affect your wallet. Now is the time to pay attention and prepare for a more unpredictable financial future. The $100 billion T-bill auction is more than a headline. It's a symbol of a fundamental shift in America's financial strategy. The government's turn to massive short-term debt brings immediate cash, but also new volatility and risk. Borrowing costs are rising for everyone, and investors are scrambling to adapt. Experts warn this path isn't sustainable. The risks of deficits and economic shocks are growing. The interconnected global system adds even more complexity. We're at a crossroads. The decisions made now about debt and spending will echo for generations. The auction is a wake-up call. Business as usual is no longer an option. The nation's economic stability is at stake, and we all have a role in shaping its future. Vigilance, adaptability, and informed debate are more important than ever. The strength of the U.S. economy is a foundation we all depend on and must protect.